Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of Comparable Company Analysis, a step-by-step guide to valuing businesses. When it comes to valuing businesses, comparable company analysis, comps, is a go-to method for many. It's straightforward, practical, and widely used across industries. By comparing similar companies, you can gauge a business's worth and make smarter financial decisions. Whether you're an investor, entrepreneur, or analyst, understanding this approach is essential for accurate valuations. This article will break it down step by step, making it easy to follow and apply. Understanding comparable company analysis. Comparable company analysis, often shortened to comps, is a popular method in financial valuation. It's a tool used to estimate a company's worth by comparing it to similar businesses. This approach is widely embraced due to its simplicity, practicality, and real-world relevance. What is comparable company analysis? Comparable company analysis is a valuation method that assesses a company by looking at other businesses with similar characteristics. These companies, called peers or comparables, typically operate in the same industry, have similar revenue sizes, or share key financial metrics. By analyzing the peers' performance, analysts derive benchmarks to estimate the valuation of the target company. Think of it like house shopping. If you're interested in buying a home, you'd look at the prices of similar houses in the same neighborhood. These comparisons help you decide what a fair price might be. Similarly, comps uses financial metrics like revenue, earnings, or market value to establish a range for the target company's value. This method relies on accessible data, making it one of the most straightforward valuation tools available. Purpose of comparable company analysis. Why is comparable company analysis so widely used? It boils down to its effectiveness and ease of application. Investors and financial analysts use this method to determine fair value. Comps provides a baseline for assessing whether a company is overvalued or undervalued. Assist in deal-making. During mergers, acquisitions, or IPOs, identifying comparable valuations helps set accurate pricing. Benchmark performance. Analysts can compare key metrics of a company against its peers to understand strengths and weaknesses. Identify opportunities. Spotting misaligned valuations may reveal investment opportunities in underpriced companies. Unlike more complex valuation techniques, comparable company analysis works well in situations where immediate, real-world comparisons are necessary. Its simplicity doesn't equate to weakness. It provides data-driven insights that drive decision-making. Whether you're evaluating a startup or analyzing a large-cap public company, having a list of comparable businesses can provide a clear snapshot of value relative to the market. Key components of comps valuation. Understanding key components of comps valuation is essential to executing it effectively. Each step plays a crucial role in building a reliable analysis and ensuring accurate valuation benchmarks. This section outlines how to select comparable companies, the financial metrics to focus on, and where to source the necessary data. Selecting comparable companies. Choosing the right peer group is the foundation of any comps analysis. Selecting companies that align closely with your target ensures accurate comparisons. But how do you choose the best matches? Look for companies that share these traits. Industry. Start by identifying businesses operating in the same or a similar industry. Size. Compare companies with similar revenue, market capitalization, or employee count. Growth. Focus on peers with comparable historical or projected growth rates. Geography. Location matters. Companies operating in the same market or region often share economic environments. Business model. Assess whether the companies have similar structures, e.g., subscription-based, product-focused, etc. Imagine you're comparing restaurants. It wouldn't make sense to evaluate a fast food chain against a luxury dining brand. They cater to different markets. The same principles apply to businesses. Aligning comparable companies builds credibility into your analysis. Financial metrics used in comps. Once you've picked comparable companies, the next step is analyzing their financial metrics. These figures tell the story of a company's valuation, performance, and market standing. The most commonly used metrics include price to earnings, P/E ratio, compares a company's share price to its earnings per share, EPS. Enterprise value, EBITDA, EV, EBITDA, measures a company's market value relative to its operating income. Price to sales, P/S ratio, compares market capitalization to total revenue. Debt to equity, D/E ratio, delivers insight into a company's financial leverage. Revenue growth tracks how quickly a company is increasing its sales over time. These ratios act as benchmarks for valuing your target company. For example, if a peer's EV/EBITDA is consistently higher, your subject company may appear undervalued. Numbers don't lie, but the context is everything, so always consider external factors like market trends. Data sources for comps analysis. Accurate data drives accurate results. The quality of your comps analysis depends on reliable and consistent information. Where can you find this data? Here are some popular sources: company filings, annual reports, 10K, and quarterly reports, 10Q, are treasure troves of financial data. Market research platforms. Tools like Bloomberg, Capital IQ, or FactSet streamline access to financial metrics. Stock exchanges. Public companies often share data via exchange websites, e.g., NYSE, NASDAQ. News outlets. Financial news platforms like Yahoo Finance or CNBC also provide summaries of key metrics. Investor presentations. Many companies highlight growth drivers and metrics in investor decks. Double-check all data for consistency to avoid errors in your valuation. Remember that comparisons are only as good as the numbers you're working with. Don't cut corners here. Quality input results in quality output. Each of these steps works together to take the guesswork out of valuations. With the right comps, metrics, and data, you'll be set to perform a well-rounded analysis. Steps in conducting comparable company analysis. Conducting a proper comparable company analysis involves several systematic steps. Each step builds on the last, ensuring a thorough and accurate valuation. By following this process, you'll develop a detailed understanding of how your target company compares to others. Step 1. Define the analysis scope. Before diving into the numbers, you need to outline your scope. What's the goal of this analysis, and what market are you evaluating? Start by defining the industry the target company operates in. Industries vary widely, so narrowing this down sets the foundation for meaningful comparisons. Ask yourself, is this a tech startup, a manufacturing company, or perhaps a retail business? Next, factor in the market context. This covers the company's geographic reach, current economic conditions, and market trends that might influence valuations. For example, evaluating a cloud software company in a booming tech sector differs greatly from analyzing a grocery chain in fluctuating consumer markets. The key? Narrow your focus. Keep the scope tight and relevant for sharper results. Step 2. Identify comparable companies. Once the scope is set, you'll need to find companies that align with your target business. Selecting the right comparables is critical. The quality of your analysis depends on it. How do you pick them? Use these guidelines. Industry alignment. Choose companies operating in the same or closely related industries. Size similarity. Match companies with comparable revenue, market cap, or employee counts. Growth rates. Focus on businesses with similar historical or projected growth rates. Geographic reach. Include companies active in the same major markets or economic regions. Business model. Look for operational similarities, like subscription-based models or direct-to-consumer sales. Picture this. If you're analyzing a boutique fitness studio, comparing it to massive global gym chains won't make sense. Instead, find peer studios with similar customer bases and pricing structures. This ensures an apples-to-apples comparison. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.